How do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to today's session. We're going to discuss the non-farm payroll report. This is the one of the most widely attended events on the monthly economic calendar, and so therefore, without further ado, we're going to get right into it. If, of course, you have any questions, please feel free to ask them in the question and answer chat area. It contributes more to the dialogue effect of the presentation rather than the unwanted coma-inducing monologue effect. So what is the non-farm payroll report? It's a total of the number of jobs added to or subtracted from the U.S. economy over the last month, net of farm workers, hence the silly name, the non-farm payroll report. Now, why is it important? It's important because it provides an important indicator of the health of the world's largest economy. It is one of the most widely followed events on the monthly economic calendar. What are the effects of its outcome? If the result is approximately equal to or better than the expectation, the U.S. dollar is likely to gain strength. Now, I want you to notice the red, bold, italic, underlined word likely. I'm going to get to why it's thusly highlighted in a moment. If the result is less than expectation, the U.S. dollar is likely to weaken. How can the results be exploited? By waiting to see the true market reaction to the outcome, not the knee-jerk reaction. One trades along with a trend that can stay in train from a few minutes to several days or more. One can trade 6 currency pairs during the event, and we will take a look at those in a moment. So let's look at the potential setup for on the trading platform. This is not that. This is just a view from Forex Factory, or you can use investing.com. The calendars are virtually identical. This tells us a little bit about who creates the report, what it measures, the effect, its frequency, etc., etc. This is a histogram of the outcome of the reports, and we will get to the real one. This is an old one. But this, ladies and gentlemen, is the most important single slide on the presentation. The presentation is not, well, will account for about 10% of our presentation today, but if you come away with nothing from today's presentation, I want you to fully understand this slide. It seems a little daunting at first, but it really isn't if you think about it. There are 2 possible outcomes in terms of the report itself, positive or negative. There actually is a third, but it's highly unusual. It's rare. That would be the event that the report comes out printed black as opposed to green or red, which means it comes out almost exactly, or it's literally exactly according to the expectation, which I can't remember the last time that happened. So we have 2 possible outcomes, positive or negative. Now, in the event of a positive outcome, you'll notice that the currency pairs with the dollar on the right will go down. We sell them. Those are puts. We sell them. And, of course, the dollar on the left, we buy them. They go up. Now, this is for a very simple but essential reason that you must keep aware of at all times. And why do I emphasize this? In live trading events, they're very exciting. There's a lot of excitement and action, and it's very easy to misexecute. We don't want to misexecute. We don't want to get into the wrong position right off the bat and immediately be in a loss unnecessarily. That can happen in itself with the risk involved. Remember, these are the capital markets, and you should only be trading with money you can afford to lose here. But the idea is to keep your head on straight so that you don't misexecute. Now, why would these go up and these go down? Due to the positioning of the dollar in the pair. You'll notice in these boxes here, there's a line. That line is not a grammatical indicator. It's a mathematical operator, and it indicates ratio or proportion. And proportion is always the left-hand element has an exponent of 1, and the right-hand element is denominated in the numbers on the vertical axis of the graph, the y-axis of the graph. So if, as the dollar strengthens, remember we saw in this chart, if the result is positive, and we're talking about the positive expectation here, the dollar strength, it's going to take less dollars to buy the single Aussie, the single Euro, the single sterling, because the left-hand elements, or what are called the base currencies, have an exponent of 0. So in the case where the dollar strengthens, these pairs, because the dollar is on the right, will go down. And vice versa where the dollar is on the right. It'll take more yen to buy the singular dollar. More Swissy, more cash. That has to be clear in your minds, ladies and gentlemen. If you have any questions, please ask them now. And of course, the inverse in the event of a negative outcome. Our dollars will weaken and therefore require more to buy the singular dollar, the singular euro, or the singular sterling. And vice versa where the dollars are on the left. More yen, less yen to buy the singular dollar, less Swiss, etc., etc. So it's important that you keep those ideas straight in your head. It's important that you keep your head screwed on fairly tightly because live trading events are very exciting and very easy to mis-execute. Questions, ladies and gentlemen? All right, now this is a picture of the trading platform, and we are here on my favorites section, and you see that I position them more or less in that same grouping with the dollar on the right, dollar on the left, though there are notable exceptions to that, but for technical reasons I won't get into. But suffice to say, it's the same logic, so that when the report comes out and we see what the market is up to, we trade accordingly, buy or sell the pair. And this is just a picture of a position, and the idea is to show you that some of these positions, occasionally, not all the time, can be profitable over the weekend. And as you know, holding positions over the weekend is an expensive proposition. Nonetheless, if these trends are strong enough, we can, through fairly moderate-sized positions, make a nice profit if it works out for us. It doesn't always work out, and I want to make you aware of those risks, and now I'm going to talk about those risks in detail. Ladies and gentlemen, it's my practice to state clearly and unequivocally that there is risk in this particular trading event, as there is in all capital market activity, period. I say this not only because the regulations under which we as a firm and I as a registered securities dealer operate obliges us to, but also as someone who has long experience in the capital markets. I well understand that particularly for beginners, the lure of fast money and easy profits can quickly shatter on the rocks of market fickleness. And let me be ultimately specific about what market fickleness means. The trades one enters into to exploit the non-farm payroll report have a high likelihood of transpiring according to expectation, meaning that the cause and effect between the outcome of the report and the market's reaction to that outcome are likely to occur in the way one anticipates they will. However, they sometimes don't. That is the risk in all capital market activity, the probability of the unexpected occurring. That is the very definition of risk, and occur it does. The reason we wait a few seconds or more after the release of the report to enter positions is precisely to witness the market's reaction. This is so because sometimes the market simply does not react in the expected way. There are no two ways about this. These are human beings participating in an entirely human undertaking. So what I want to emphasize to you, particularly the newcomers and people unaware of what we're dealing with here, economics and finance makes a terrific effort to represent themselves as scientific. They show graphs and charts, and they look like this stuff here. It looks like engineering. It looks like science. It ain't. Okay? This is why economics is called a social science and not a natural science. Despite the strenuous attempts by economists and financiers over the millennia, and I emphasize millennia because financial trading goes back at least 4,000 years. The first known financial transaction in the sense of a future as an option contract, depending on how you tell the story, was Thales, the Greek philosopher, who anticipated a bumper crop in olives in Greece about 2000 BC. Science is deterministic. This means that what is understood to be a constant phenomenon in nature can be relied upon with certainty. Buildings can rest on these certainties. Civilizations can be built on those certainties. Economics and finance are social sciences because they attempt to understand a human enterprise. Humans are emotional, irrational, erratic, and often do not act in their own economic interests, contrary to classical economics, which generally doesn't know what it's talking about at least half the time. Therefore, there is a significant element of risk in their behaviors as individuals and their collective behavior as a market. Make no mistake about it. There's risk here, and that's what risk is defined as. The probability of the unexpected occurring, and it occurs. The herd instinct, and that's demonstrated in the behavior of these large movements of creatures, where only a very few of them can actually see the way ahead. The rest of them are forced to follow signals by the creatures in front of them to stay alive. This herding instinct is the most precise unifying principle explaining the market's behavior. Forget the graphs, the charts, the indicators, and algorithms that economics foists as deterministic tools of the trade. They are not. They are probabilistic tools. This means that we can say that under particular circumstances, say the NFP report, we expect the market to behave in a certain way, with a certain probability. In other words, when X occurs 8 out of 10 times, Y will happen. It will not happen 10 out of 10 times, nor can we be sure which of the 10 times will behave like the 8. Risk, ladies and gentlemen. It does not always have a familiar face. So with that, I'm going to bring the prepared portion of our session to a close, and now we'll move on to the live charts, and we'll take a look at some of the actual methodology we use to assess what's going on in the market with the non-farm payroll report and how to exploit any opportunities that may present themselves.